Last but not least, we will cover the joint venture agreement. Joint venture is a new creation of private equity solutions. It's a mixture, a little bit of the separate account, a little bit of the private placement, and it will surprise you with the returns. Let me give you the basics. The basics are, just follow me, I'm going to divide the line right here because the left side is going to be some numbers, so we can come back and review it, okay? First of all, you're going to have a joint tenancy in common. In plain English means that we co-own the property. So we have ownership. And that's important because that gives you safety and collateral. Real estate will be the asset. And remember that real estate can be good investment and bad investment. In this case, we're going to look for investments that our average has been in the last 7 years. We have around over 80% accuracy of identified good acquisitions. So it's going to be a property and it's going to be on a specific real estate. So it's on a specific project. As you can see, this has the elements of the separate account. You're going to have protection of principal and title. That means that we will make sure that the property is valid, legit, and will be able, in case of the worst case scenario, you are protected because the value of the property probably is going to exceed the amount that you contribute. We're using a 12 months time frame. So we're not looking for a huge time to wait for your money to get back to you or get a return. I think it's pretty quick, and in real estate it's pretty quick. The definition by securities, by the way, of by standards of accounting, any asset that can be converted in cash before 12 months is considered very liquid. Okay, it's considered short term. 5, we're gonna have additional collateral and funding available in case that the market turns against us and the valuations goes down, so we can protect your collateral and your investment. That's very important because this is a risk management, it's a hedge for your investment. Now, this is the good thing. Number 6. We're going to provide a 10% profit sharing of the net profits of the investment. And number 7, you are going to have a specified and a specific predetermined rate of return of your investment and contribution. It will be based in the amount that you invest. In summary, we get a property as collateral, not as a fund like the private placement. Real estate is going to be specific. You're going to use our expertise and our track record, which we can show it to you. It's going to be part of the web page. And you're going to see that it's a very good track record, consistent in good, bad, and regular times. Protection of principal and title, 12 months time frame, additional collateral if needed, in case that the investment goes sour or south, 10% profit sharing of net profits, a predetermined rate of return based on your investment. These are the rules of the joint venture agreement. Mathematics are for you. If you get $100,000, our average return is around 20%. net. That means that of those $20,000, you get 10%, which is equal to $2,000. But in addition to that, you will make 8% of $100,000. That will give you a total return of $10,000 of $100,000. That equals 10%. Which investment today can provide you in 12 months 10% with a possibility of 10 with a minimum of 8? So you have growth and you have income. But it gets better. Let's assume that instead of $100,000, you like this idea and you invest $250,000. The mathematics works a little bit different because now instead of getting 8% return on that money, you are going to get 10% of predetermined rate of return. It means that of 250, let's use our example, the average return was 20% of average investment property. You got $50,000 in profit. We share with you 10%, which equals $5,000. But 10% of 250, it's $25,000. So the total amount of income and total return that you get in 12 months is $30,000. 30 divided by 250, it's equal 12%. Which investment with 250,000 will give you a minimum of 10 and a maximum of 12 in 12 months? Very few. It gets better. Let's assume that you invest $500,000. The 20% average return of our properties, net means after cost, is around $100,000. $10% of that amount, it will give you $10,000 extra return. But for a $500,000, the predetermined rate of return that we're going to offer in this joint venture, it's going to be 12%. So if you get 500 times 12, that's fixed. This is fixed. We're paying that in 12 months. Doesn't matter what. And you get $60,000. But if we execute what we have done in the last 7 years in average, which is 20, that will give you a total of $70,000 on a $500,000 investment for 12 months, and that will give you a total return of 14%. And that's using private equity solutions expertise with the track record that we're willing to show you. We got statements, we got all the track record of all the properties for the last 5 to 6 years. We give you a predetermined rate of return. We collateralize the investment in a joint venture. We provide additional safety in case things turns down. We got the liquidity and the resources to provide private funding for that. And at the same time, it's a 12 months time frame. So we're excited about this model. I think it's a fantastic way to invest. It's, like I say, it will be great and part of a total financial wealth plan for your family, for your investments, and for any investment that you have that right now is not being maximized or there is not producing the kind of return that you need to purchase your goods, keep your standard of living, and especially get a better retirement. So I hope that you like it. I love it. I think it's a great opportunity, and we look forward for it.